3 weeks ago, I warned you that the cannabis stocks had suddenly become, let's say, a lot more risky. Last year, this whole group traded on hopes and dreams. This year, it started trading the actual numbers. And those numbers, well, they simply haven't matched the wildest expectations of the bulls. I told you the marijuana space was going to get a lot tougher going forward, but even I had no idea it would get this bad this fast. Over the past few weeks, the whole Ganju group has been crushed with some truly hideous breakdowns. Most of the group is down 7 to 17% since I warned you about the industry. I knew Wall Street was becoming more critical of the Cheech and Chong cohort. I didn't know it would deteriorate like this. There's a cloud of pessimism here, and not just because these companies keep failing to live up to early expectations. On top of the not-so-hot numbers, there was a particular Canadian cannabis producer known as CantTrust, CANNTRUST, with a particular problem. See, CantTrust ran afoul of the regulators. Earlier this month, it was forced to announce that it had been deemed non-compliant by Health Canada for selling product that was grown in unauthorized rooms of its main cultivation facility. Remember, marijuana may be legal in Canada, but it is also heavily regulated. Then last week, we started hearing reports alleging that CantTrust executives had knowingly skirted the regulations and misled regulators. That's why over the course of this past month, this stock has lost more than half of its value, plummeting from $5 down to $2.35. As the scandal keeps blowing up, the pin action has been horrendous for the rest of the group. Some analysts are talking about a CantTrust contagion. So how bad is this problem for the cannabis cohort? Should you be afraid, or is this the moment to be opportunistic, using the weakness to do some buying in some of the higher quality pot stocks? Okay, we're going to start at the epicenter of the decline, the CantTrust meltdown. Here's a company that got its medical marijuana license way back in 2013. Management claims they make standardized products that allow doctors to give patients accurate doses. That's so hard to get. They're trying to grow weed that's almost as consistent as actual pharmaceuticals. Think GW Pharma. Why that stock's been so great? Because you can dose it. Now, these guys have got a big greenhouse right across from Niagara Falls that could potentially produce 50,000 kilos a year. They're adding more square footage in order to double production next year. And they've got a manufacturing center where they turn their plants into finished products that can be sold at dispensaries. CantTrust recently acquired a bunch of land in British Columbia for outdoor cultivation, too. That could add another 100,000 to 200,000 kilos of capacity by the end of next year. They were expanding into new categories, too, including over-the-counter products, natural health care, health and beauty, even pet care. So this was a super growth play. CantTrust listed on the New York Stock Exchange in February. But after an initial run up to $10 in March, the stock rolled over and has spent the last 4 months being clobbered. It's now lost more than 75% of its value from its peak. So CantTrust had already been a loser for months before the big meltdown in recent weeks. These guys were hardly alone. The whole group's been under pressure, like I mentioned before, but this was still a uniquely poor performance. The culprit? Investors started caring about the actual results this year. Remember, Bruce Linton was fired from Canopy. Actual results matter. The numbers have been disappointing, to say the least, in some of these stocks, CantTrust in particular. In March, CantTrust reported a nasty shortfall on both the top line and the bottom line, in part because of lower pricing, especially for oil products. While the company announced a 10% price hike for many products, it wasn't enough to offset the lousy numbers. Still, there was some good news, too. In April, CantTrust got a license to expand its main cultivation facility, but they were still waiting on approval from the Canadian regulators to start the next leg of that expansion. And they also waiting for permission to start growing weed outdoors in British Columbia. The land could potentially produce 75,000 kilos by the end of the year. That's a huge increase, given that they grew less than 10,000 kilos of cannabis in the first quarter. All told, management was talking about having 200 to 300,000 kilos of capacity by the end of next year. This is symptomatic of the broader industry. You had yet another company talking about its planned productive growth and its estimated capacity, though all this was a done deal. But in 2019, marijuana investors are a little sick of plans. They want returns. They want results. The next leg came down in late April, when CantTrust announced a $200 million major secondary offering when the stock was trading at $7.52. At the time, this was about $1 billion company, so that was a big slug of stock, and the deal ended up pricing at $5.50. Ouch! That's the context for the recent meltdown. On July 3rd, CantTrust admitted that production expectations needed to be ratcheted down. They've been guiding for 75,000 kilos from the big outdoor farm, but Health Canada still hadn't even given them a permit. So management told us the real number could be like 15,000 kilos for 2019 if they got approval within the next month, or closer to zero if the regulators waited until August 5th. Brutal. And that wasn't the worst of it. On July 8th, we learned Health Canada had deemed CantTrust's main production facility in Ontario non-compliant. The facility has 12 rooms, but 5 don't have licenses yet. Health Canada charges that the company was growing weed in those rooms, nearly half the facility, and then they were lying about it. The regulators placed on hold 5,200 kilos of cannabis that was harvested from these rooms. They can't sell it until they comply with the rules. Due to the inventory freeze, CantTrust said some customers could experience product shortages. Since then, the stock has been radioactive. Didn't help when a Canadian newspaper leaked emails showing that CantTrust executives had known about the malfeasance. Last Thursday, the CEO was fired, and the chairman was forced to resign. Stock actually rallied 17% on the news, tacked on another 9% when the new interim management announced a strategic review. Well, they're looking at options to turn things around, including putting the business for sale. But who knows if any buyers will be interested. Now, there's another big cannabis story last week. Curaleaf Holdings, a U.S.-based company, had to dust up with the FDA. They inked a big deal with CVS to sell cannabidiol products, also known as CBD. But it turns out their CBD lotion, CBD pain relief, CBD vape pen, and CBD tincture have been deemed unapproved by new drugs by the FDA. After initially getting slammed, the stock managed to bounce back. They may just need to change how they label the stuff. Still, it is clear the FDA is starting to flex its muscle against cannabis. The fallout from these two mishaps has devastated the entire sector. Nearly every pot stock's down 5 to 20%. My view, I think you need to be incredibly selective here. I still like Canopy Growth and Cronus, two best-funded Canadian cannabis plays, but these are long-term stories. You need to be prepared to buy them gradually on the way down. The bottom line, when it comes to the marijuana space, the new paradigm, it means you need to stay away from companies that only have vague plans pending regulatory approval that are losing a lot of money. Stick with the big guns like the well-capitalized Canopy and Cronus that are ramping production. And even then, be prepared for a lot of pain as weak-handed investors continue to get shaken out and the players with deep balance sheets are scrambling for cover.
The House of Pain.
Andrew in New Jersey. Andrew.
Oh. Hey, also a.k.a. Big Sal from Somerset. How are you, Jim?
Hey, how's it going?
I'm doing good. Hey, listen, I'm going to talk to you about Turning Point Brands,
right.
TPB.
Right.
I got to tell you, I picked this up a few months back, right, and it was in the mid-40s. I knew it had good gains past 3 years, and they just opened up Canada. They started getting, so I said, this has got to be a win. You know, because they make like zigzag papers and then things like that.
Right.
If you have up in Canada, all they do is smoke and go to comedy clubs. That's all they do. Things that win, right?
Right,
so anyway,
right.
Yeah, right. Now it's gone down. Like, I don't even know what's going on with it. My wife.
Well, this is a group move. This is a group move, Andrew, because you're absolutely right. This is a good one. It actually makes money. It's got plans, but it's being pulled down by its compadres. In that kind of situation, I think you got to stick with it. Doesn't mean you can buy it. You got to wait for the group to bottom. This tape has gotten very tough, and it's very tough on stocks like this. All right, when it comes to the marijuana space, I had to do this piece. I got to tell you, because this can't. You needed to know why things are going down. All right, I still think you got to be ready for even more pain. Much more Mad Money ahead. Contour Brands was spun off from VF Corp at the end of May, but is it time to wrangle an investment in the new company? I'm offering my take. Then, what's Apple's stock really worth? I'm doing some back-of-the-envelope algebra and offering my take. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.